Hello, this is Jordan, and this video is being recorded on the late morning of Monday, October 31st, 2016. And today I'm going to talk about the one key intermarket relationship for gold that I'm going to be watching closely in the weeks ahead. Now, this chart here, before we get to the relationship, this chart here plots a few different things. We have gold at the top, the real Fed funds rate in the middle, and the Fed funds rate at the bottom. Now, the real Fed funds rate is just the inflation adjusted federal funds rate. So that's interest rates minus inflation. At the bottom, that's the Fed funds rate. Now, we know that that real interest rates are the fundamental driver for gold. That is positively declining or negative real interest rates. That's the positive driver of gold. And in this chart, what we did is we highlighted periods when the Fed was raising rates and the Fed funds rate went higher, but gold also went higher. Now, starting off in the late 1940s, the gold price was fixed, but from 1947 to 1951, commodity prices made a huge move higher. And during the beginning of that period, or at least the first half or first two-thirds, the Fed, they started raising interest rates again, and commodity prices again had a huge run from 1947 to 1951 during that time, and the gold price was basically fixed, so it didn't really do anything. But moving on to the other periods, everybody knows about the 1970s when interest rates were rising, but gold kept rising. And the reason for that is because the real Fed funds rate was declining, and it was also negative for a good portion of the 1970s. So, in other words, inflation was rising faster than interest rates. The Fed was raising rates, but they were behind the curve because inflation was rising much faster, and that's what drove gold much, much higher. Now, in the current secular bull market, we haven't really had rising interest rates. We've had negative real interest rates for most of the period since 2000. But there was one part in the early 2000s, essentially from about 2004 to 2007, when the Fed was raising rates. And during that period, gold still made a nice move higher. It still went up even though the Fed was raising rates. And that's because, again, inflation was rising faster than interest rates. Now, with respect to this year and gold going back into a bull market, gold has performed well because inflation has been ticking higher and because the Fed has been putting off this next rate hike. I mean, coming into the year, I think there was an expectation that the Fed was going to hike multiple times. And of course, they haven't even hiked once. So inflation was going higher, interest rates were not going higher. That was bullish for gold because negative or real rates were declining and they were in negative territory. Now, gold and gold stocks are correcting now because fundamentally, of course, the Fed was putting off that hike. That was bullish for gold. Now we have the reverse where it looks like the Fed is going to hike in December. The market is pricing that in. Up until the Hillary email thing, it was 74% priced in. And so that, of course, is negative for gold in the short term. But the thing is, if we are in this new inflationary period, I mean, I've talked about this in the last couple of videos where inflation is rising, indicators of inflation, market indicators of inflation and inflation expectations are clearly rising. They're breaking downtrends. So we're in this period and interest rates are starting to rise. The Fed is going to hike. That temporarily is negative for gold until the point when the market believes that inflation is rising faster than interest rates. And so let me get to the next slide. So how can we get a market indicator of that? How can we kind of anticipate that? Well, a big way to do so is to look at gold versus bonds. How is that relationship performing? And also here we have gold against the US dollar, but that's not as important because gold against bonds, the bond market is by far the biggest market in the world. There's tons of money in that market. So That's really the thing we want to focus on here. And rising rates are, of course, bad for bonds, and temporarily they're bad for gold until the market, as I said before, the market senses that inflation is rising faster than rates. And how can we anticipate that turning point? Well, it's the gold against bonds relationship. And we see it here at the top. That's a daily plot. We have the 400-day moving average. And notice the 400-day moving average, again, is an excellent job of defining this relationship. And what we've seen in recent months is the ratio is now rising. It's what I should say. In recent months, it's consolidated, but it's consolidating above the 400-day moving average, and the 400-day moving average is now starting to rise. And resistance is at 8. I don't know if this is going to break out immediately. I mean, it might take a couple more months, or maybe even 3, 4, 5 months. I don't know, but this looks like at some point heading into the next year that we're going to see a breakout in favor of gold. And when we do see that breakout in this ratio clears that 8 hurdle, it's at 8.00, that's going to tell us that gold is decoupling from bonds and the market is sensing that inflation is rising faster than interest rates. Again, hasn't happened yet. The relationship, it's been consolidating for 4 or 5 months or so. It may continue to consolidate for several more months, but if and when this does break higher, that's going to be very positive for gold. So that's something I'm watching very closely. And again, that's more important than the gold against the U.S. dollar index. But I put that on here because it's a similar relationship, and you can see the chart looks fairly similar, although it's not quite as strong as gold against bonds. But gold has held there the 400-day moving average, and it's starting to slope higher. So this is something that will be very interesting to watch as this year ends and we head into 2017. Okay, and that's basically all I have in this video. You can follow more of my work at thedailygold.com. Opt in there for my free newsletter. Also subscribe to my YouTube channel. And you can consider my premium newsletter. Our model portfolio over the last 7 years has returned 440% at its peak, and that was at a time with GDX down 20% and GDXJ down more than that. So again, you can go to thedailygold.com, subscribe for my free newsletter there, and subscribe to my YouTube channel. Thank you so much for listening and watching this video. I really appreciate it, and I look forward to doing another video for you in the next week or two.